It's I want us to do something under budget. Remember, those who are doing business data analytics, you will be handling budget. Those who are doing advanced management accounting, your topic number 7 has got budget concept. Those who are taking management accounting at intermediate level, don't forget that topic number 9 is budgetary control, right? So all these groups, I believe, one or two of them has been able to join the meeting, and we are going to do it at the level or at the pace that is convenient for every group. So we will be using this particular question. I believe you have the file with you from your site. It was shared with you. So when you're joining this meeting, that link has got what we call class file link. So when you use that class file link, you'll be able to see the file. You'll be able to download the file that I'm actually displaying on my screen. So please confirm to me that you have been able to access that file. Please confirm to me that you have been able to access that file. Alternatively, I am going to post it here in the chat box so that you download it. Yes, thank you. John has actually shared the link that has got the document we are using for this particular session. Good. So I'll basically now move to this. We have 2 of them. Of course, at your free time, you'll be able to handle or look at what was tested in BDA exams. But of course, we're going to use this for our today's session. Flexed budget, the second file or worksheet, that is Motomoto Limited. That is Motomoto Limited. So the question reads, Motomoto Limited operates standard costing system. The following budgeted information relates to its only product. So this particular company is producing one item. It is producing one product, or maybe if they are producing more than one, but what we have here is only information related to one of their products, right? So we have what we call standard cost per unit. The standard cost per unit is basically a company going into its database, looking at maybe their transactions over the last 12 months, their transactions over the last 2 or 3 years, right? Then from that, they get the average. So from the average, they can now be able to come up with a standard or a trend. So that trend, which is now used in doing forecasting, is what we normally call the standard cost, right? Or budgeted costs, right? So the budget is made from previous transactions or even the average of the previous year's transactions. So we have these expenses that have been incurred. For them to produce this particular product, they need 3 kgs of direct material A. And each kg of material A is equal to 140 shillings. So when you take 140 multiplied by 3, it is giving us 420. So that is the cost per unit. That is the cost of direct material incurred to produce 1 unit of their final product. Then remember, this product requires 2 types of raw materials. So we have material number 2, that is material B. For material B, they need 2 kgs to produce 1 unit of the final product. And each kg of material B is purchased at 250 shillings. And that's what is giving us 500 shillings. We have direct labor. So they need 2 hours to be able to do production of the final product, and each labor hour is paid at 105 shillings. Good. So having looked at the prime cost component, we need to look at the production overheads. So if we were having variable production overhead, then we'll be talking about marginal cost, right? So what has been done here, we only have fixed production overheads. So when I bring in the fixed production overheads to the prime cost or marginal cost, I will be talking about full costing method. So the company uses what we call full costing method in dealing with its product or in the production process. Now, these fixed overheads, we all know that fixed costs are normally constant. right? That fixed costs are normally constant and do not change with changes in volume of output, right? Now, how will you be able to get the total fixed cost that will not change when the volume of output will actually be changing? So we need to look at what we call budgeted. We need to look at the standard fixed cost at full capacity. We need to look at the standard fixed cost that's supposed to be incurred at full capacity, right? So how do we deal with that? It will take us to something which you learned, which is called overhead absorption rate, right? So overhead absorption rate is equal to budgeted overheads, budgeted overheads. We divide by what you call budgeted activity level. But now, to be specific, which overheads are we talking about? We are talking about fixed production overheads. We are talking about fixed production overhead. So let's look at what we call fixed. Our overhead absorption rate will be equal to fixed production overheads, fixed production overheads divided by budgeted activity level. In this case, the fixed production overheads, you can clearly see they are incurred based on the number of units. The fixed production overheads do not depend on the labor hours. The fixed production overheads are not absorbed as a percentage of direct material or prime cost. So our budgeted activity level is basically units produced. So budgeted production in terms of units. Great. Now, having done that, are we able to get the fixed production overheads? Because we need to have total fixed production overheads. Do we have total fixed production overheads? We don't have that, right? How about budgeted production? If we read the entire question, so let's just move down and see any other information provided. So budgeted production amounted to 800 units at a unit price of 1,300. That is now the budgeted production in terms of units. Good. Then we are being told that actual production data for the month of November 2023 were as follows. We have sales revenue. So when 850 units were actually sold, this is the total revenue received, right? And actual cost incurred for direct material, A, direct material, B, direct labor, then fixed overheads now, the actual. Then we are being told that actual output amounted to 850 units. Good. Additional information. Number one, budgeted fixed overheads for its product is based on budgeted output of 800 units per month. So basically, they are trying to tell you that at full capacity, the company is supposed to produce how many units? 800 units. So if you want to get the total fixed overheads, the budgeted fixed overheads, which will not change with changes in volume of output, is the total fixed overheads at the production level of 800 units. Then number two, standard selling price was budgeted as 1,600 per unit. The standard selling price was budgeted at 1,600 per unit. Number three, there was no opening or closing inventory of direct material. Good. So with that, what are we required to do? We are required to get flexible budget profit statement. Flexible budget profit statement. So we'll, of course, go beyond this and even come up with a reconciliation statement. We'll be able to go beyond this and come up with a reconciliation statement. So let's see what is provided there. So the first thing we need to get is the overhead. So we need the overhead absorption rate. We need fixed production overheads. We need budgeted production activity level or budgeted production in terms of units. So if you look at this entire equation, they must just deny you one item. So can we use what is given to get the unknown item? So overhead absorption rate, we are basically now referring to what we call fixed overhead absorption rate. Now, as per the budget, are you able to tell me fixed overhead per unit? Fixed overhead cost per unit? Is there someone who can tell us? Fixed production overhead cost per unit. Fixed production overhead cost per unit. If you look at our standard activities here, the standard activities in terms of the direct material, direct labor, and all that, how much is it per unit? How much is it per unit? 270. So that 270 per unit of output, because our activity level, our cost driver is the budgeted production, we'll now talk about this 270 as our fixed overhead absorption rate. So if you're given 270 as the fixed overhead absorption rate, then we say it should be equal to fixed production overheads. It should be equal to fixed production overheads, then over budgeted production. As per the budget, how many units are they supposed to produce at full capacity? As per the budget, how many units are they supposed to produce? How many units? So that is the budgeted activity level, right? The budgeted activity level of 800. So if you do that, you can clearly see that the only unknown item is the fixed production overheads. Please go ahead and give us fixed production overheads. Go ahead and give us fixed production overheads. So our fixed production overheads, if we make it the subject of the formula, we are going to multiply both sides by 800 over 1, right? So when I multiply both sides by 800 over 1, we'll be having 270 multiplied by 800, multiplied by 800. What are you getting as the fixed production overheads? It is equal to 216,000. It is equal to 216,000. So that is the budgeted fixed production overheads. You can actually add the word budgeted fixed production overheads. Why are we struggling with this budgeted fixed production overheads? We need it. We need that fixed production overheads because we are required to prepare flexible budget. So this flexible budget will only come into place when we have the budget or budgeted activities and compare with the actual, right? Good. Now, for us to also have what we call flexible budget, then we need to calculate what we call flexing ratio. We need to calculate what we call flexing ratio. Good. So how do we normally calculate this flexing ratio? Is there someone who can tell us how to calculate the flexing ratio? What is the formula of getting the flexing ratio? What is the formula of getting the flexing ratio? Flexing ratio, it is actual production divided by budgeted production. Okay. Thank you. So flexing ratio is equal to actual production divided by actual production, right? Good. So do we have that in our question? So our flexing ratio should be equal to, actual production. So if you go to the actual results table, how many units were actually produced? How many units were actually produced? If you go to the actual results, we have it somewhere here. how many units were actually produced? 800 and 850. Then we divide by budgeted production. I've seen there's a slight error. Budgeted production, they budgeted to produce 800 units. So that will give us a flexing ratio of 1.0625. So it should be over budgeted. Good. So this is the flexing ratio. Why are we moving forward to calculate the flexing ratio? This flexing ratio will be used to adjust all the variable components of our cost, right? All the variable components will be adjusted using the flexing ratio. All the fixed costs will not be affected by the flexing ratio. They will be constant, right? So let's now come to this part and talk about details. Let's have details. And under details, we are talking about direct material. Direct material. Actually, we can start with sales, right? We can start with sales. Then to sales, we now deduct all these expenses. So we have direct material. We have direct material A. We'll be having direct material B. And of course, we'll be having what we call direct labor. Direct labor. And then we have fixed overheads. And then we have what we call fixed overheads, because there's a question here. Direct labor on the standard cost is supposed to be 210. So direct labor is 105 per unit and 105 per hour, and we have 2 hours. So this should be a 210, not 110. Yes, that should be 200 and that should be 210. Yeah, that should be 210. So we should be able to rectify that as we do our workings. Thank you for that. Great. So let's see. Once you did adjust all this, we are going to have what we call net profit. You'll be having what we call net profits. Good. So under details, let's start with a very important thing here, which is units produced. Units produced. Good. So we start with the first part, that is budget. Budget, original budget or initial. So original budget or initial budget, they budgeted to produce how many units? They budgeted to produce 800 units. And what is the selling price per unit? The budgeted selling price per unit we are given somewhere. That's the standard. So the standard selling price was budgeted as 1,600 per unit, right? So 1,600 per unit, and their budgeted production and sales is 800 units. That will give us total sales of 1,280,000, right? Now, how about direct material? Direct material, 1 unit of material, 1 unit of the finished product requires direct material whose cost is 420, right? So 420 we multiply by the number of units, right? So it will give us total direct material cost. How about material B? Material B, each is supposed to go for 500 each unit, and they managed to produce 800 units. That will give us direct material B of 400,000. Direct labor, we have identified that each hour is supposed to be 105, and they utilized 2 hours to produce 1 unit, right? So that will give us total cost. Then to the total cost, we are supposed to consider that this was done for how many units? For 800 units, right? Great. And our fixed overheads, we actually calculated it up here. Budgeted fixed production overheads, 216,000. Why not 1,300? Good. So look at it here. Budgeted production amounted to this one at a unit price of 1,300. The 1,300 we are having here is the total cost, not selling price. 1,300 is the total cost. They have extracted it from this point. So I want us just to confirm that when we add all these, we are getting 1,300. I want us to confirm. Let's differentiate between cost and revenue, right? Let's differentiate between cost and revenue. Let's consider that. Are we getting the same thing? Good. So it should not be, it should be 1,400. Yeah, it should be 1,400. So we are changing this to 1,400, and of course, this cost is also 1,400, not 1,300. It is 1,400. Thank you. Good. So can we now get net profit? How do we get net profit? Very simple. I will simply say that my net profit is equal to, my net profit is equal to all the expenses, all the expenses, all the expenses. So these are the expenses. I put them together, then deduct from my revenue. Deduct from my revenue. It will give me 160,000. Alternatively, someone will decide and say, okay, it is equal to total sales or revenue minus direct material minus material B, direct labor, fixed production overhead. So if I do that again, I'll be able to arrive at the same thing. Good. So I want you to confirm to me that we are all getting 160,000. Confirm to me that we are all getting 160,000 as the net profit. Are we all getting 160,000 as the net profit? Great. Now, there's a problem. For us to be able to come up with a flexible budget, we cannot compare these with different units, right? So we have to flex our budget. We have to make our budget to be equivalent to actual production. So this unit is equal to 800, right? But if you look at actual production, they produced 850 units. So you cannot compare 800 and 850. We have to flex it. We have to adjust this one here to be equivalent to 850, right? So I'll talk about flexing ratio. What did we say about flexing ratio? Our flexing ratio here is 1.06, right? So that flexing ratio will apply to every single item that depends on the number of units, right? So let's come here and talk about flexed. Flexed budget, right? So for us to come up with a flexed budget, we must get equal number of units. So how do we do that? We take the units, anything that depends on the number of units, we multiply by the flexing ratio, right? We multiply by the flexing ratio and do it all the way to the last part. So I'll take this multiply by the flexing ratio, this by flexing ratio. But when I get to the fixed production overheads, it does not depend on the units of output. So I just transfer this figure without that flexing ratio, right? I just transfer that figure. And if I want to retain the formula, do it all the way to that part. It will be able to give me now net profit as per the flexed budget. As per the flexed budget, right? Good. And imagine once you do that, you now go to actual results. So actual results, how many units were actually produced? 850, right? What was the revenue? What was the revenue? The revenue is 1,326,000. 1,326,000. How much was incurred for material A? How much was incurred for material A? 325, 350, right? How about material B? 270,000. How about labor? 97,900. And fixed production overheads, 229,500, right? That is what we have. So what is our actual net profit? Our actual net profit is equal to 403,250. Of course, that is what we are having here. That's what we are having here. So at this particular point, it is now okay for you to do what? To compare this and give us variances. It's now right for you to compare this and give us variances. Remember, we could not get variances by looking at original budget and actual results directly. Why? Original budget has got 800 units. Actual budget has got 850 units. So I cannot compare 800 and 850. No. So what I need to do is I have to ensure that this original budget is adjusted to be equivalent to the actual production. So it means under variances, I'll be comparing flexed budget and actual results, right? So when I come to this part, I should not have any variance for the units. I should not have any variance for the units, right? Yes. Now, I want us to reason together. If you budgeted to have revenue of 1,360,000 and your real revenue is 1,003,200 or 3,026, 1,326,000. So you can see you received less. Yes, if I take it this way, I'll be getting a positive figure. But that is not right. Why? My revenue is less than what I budgeted to get. So this will be a negative. This will be a negative. This will be a negative. It will be an adverse. It will be an adverse variance, not favorable. It will be an adverse variance. I budgeted to spend 357. I spent 320. I spent 325. So that is now favorable. The fixed cost, 216, 229. That is adverse, right? That is what we have there. Then can we now get the net of the variances? Net of the variances all the way from here. Net of the variances is equal to 219, 750. So when you look at actual net profit, if you look at your actual net profit, or even start with budgeted, not even actual, start with budgeted. When you start with your budgeted net profit, not any other budgeted, but flexed budgeted net profit of that amount, right? Then I need to add net variances, add net variances. So net variances is equal to the net amount of changes in variances. Then I add the two. It should give me actual net profit. It should give me actual net profit. So this is what we normally call reconciliation statement. This is the reconciliation. This is what we call reconciliation statement, right? So when you now get to this particular concept, it is there in advanced management accounting, it is there in management accounting, it is there in business data analytics. That is what you'll be required to do. There is no difference. It is the same method, it is the same procedure, right? And if you want to now know that what I'm trying to tell you is actually the fact, then look at what BDS students got in their exams. Look at what BDS students got in their exams. That is August 2024. August 2024, they were given a question here, right? Of course, the budgeted activities. We have actual results. Then they are being told to do what? Prepare a flexible budget for 1,500 units. Determine the total flexible budget cost of 1,500 units, right? So you can clearly see, prepare an income statement of this particular company at different levels of production. So it tells you that this concept is there with you. So long as you are doing CPA course, then you must just be able to understand how it works. Good. So before I say anything, are we together up to that point? Have you been able to learn something? Have you been able to learn something? Have you been able to learn something before we assist to proceed? Have you been able to learn something? Have you been able to learn something? Great. So those who have not joined the classes at RCM, please take a step and join the classes. We have already started learning, and our rates are actually affordable. So if maybe you attempted this unit for the first time and you did not manage, then you have an option of retaking the unit. And remember, retaking the unit is not your fault. So you are going to enjoy some discounts. We'll give you some waiver to retake the unit. If it is any CPA unit, then it will be 3,800. If it is now BDA, the practical paper, you are actually charged now half of the initial fee. What if it is your first time? Yes, you sat for exams or you studied somewhere else, but now you want to join RCM. It is very simple. You are now going to enjoy, still you are entitled to a discount. Instead of 4,800, you'll be charged 4,000. Instead of 9,000 for BDA, you'll be charged 5,500. Right? What if I want to do these units for the first time? Then of course, your unit will be 4,800, or the cost will be 4,800 per unit. For BDA, it will be 9,000, or financial modeling and data analytics for CIFA students. If you are retaking the units, these are the charges, right? Good. So it is very simple. And somebody is now having a question here, is wondering, how can you tell us to join, but now maybe I don't have money to pay for the entire 4,800, the entire 3,800, the entire 4,500. That should not worry you. We'll allow you to pay at least half of that amount, start learning, and clear the balance within 30 days. We'll allow you to join the classes by paying half of the fee, then give you a 30 days duration to be able to clear the balance, right? So that you can easily catch up and continue the classes. So should you want to join the classes almost immediately, this is the pay bill. If you need any inquiry, if you want to do any inquiry before you do the payment, reach out to these two people. They'll be able to assist you so that you make the right decision. Great. So that is what we have. This is the package that is there for you for the January-April semester. Great. So somebody said they were not able to understand the original figures. So this original figures, original budget, we got it from the standard cost. So 1 unit of this product requires, we are going to pay 420 for direct material A to produce 1 unit. And how many units have been produced? 800. So 800 times 420, 800 times 420 gave us 336. Material B, each we are going to pay 500 to produce a unit of the finished product, and there are 800 units. So we'll be taking 500 multiplied by 800 units. That is what gave us 400,000. How about the fixed cost? The fixed cost, we said at full capacity, the company is producing 800 units, and fixed overhead absorption rate is production overheads divided by budgeted production. Already we have fixed production overhead per unit. That is our fixed overhead absorption rate. That's why we took 270 is equal to fixed production overheads divided by budgeted production, which is 800. If you look at this, the only unknown item is the fixed production overheads, or budgeted fixed production overheads. So how do we do that? We multiply both sides by 800 over 1, right? So 800 over 1 times 270 gave us what we call 216,000. That's how we got the fixed overheads. About flexing ratio. Flexing ratio is actual production divided by budgeted production. So actual is 850 units, budgeted is 800 units. This flexing ratio will affect every single item that depends on the units of output. Right? Remember, our fixed overheads are normally constant. That is why it is not affected by the flexing ratio. And that's why it is constant. If I look at the flexed budget and the original budget, the fixed costs are normally constant. But how about the variable cost, including revenue? Because revenue also depends on the number of units. So revenue will be affected by the flexing ratio. Direct material or prime cost components are also affected by the flexing ratio. Then I come now and paste actual results. I've pasted all the actual results. So we compare actual results and flexed budget. So this original budget cannot be compared with the actual to get variances. No. Why? My original, I have 800 units. My actual, 850. They cannot be compared. I have to adjust my original to assume that what if my original was based on 850 units? What will be the budget? That's what we call the flexed budget. That's what we call the flexible budget. So once you have been able to flex it to be equivalent to the number of actual units produced, then I can now compare this. So this will be my budget. This will be my actual results. So I compare the two to get the variances. Is it clear to somebody now? Is it clear? Is it clear? 10,000 pounds. 10,000 pounds. So if this is the case, is it now making sense? Direct labor. Good. So we are able to identify that direct labor had a mistake. It is 105 per hour, and we have 2 hours. That should be 210. So this was not 110. It's supposed to be 210. We multiply by 800. 210. So that's why we took 105 times 2 first to give us 210. Then 210 we multiply by 800. So that's how we got 160. That's how we got 160. Good. So how do you present for PPS students on the variances? Good. The same thing. There's nothing unique. That's what we are going to do. Except for BDS students now, you will be told to tell us, you'll be told to go ahead and do something here. If this is adverse, you indicate adverse, right? Favorable, 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 adverse, but you don't put it manually. BDS students will be told to come up with a function that is equal to if function, right? If this figure is less than 0, comma, then it is adverse. So we put the word adverse there. Right? We put the word adverse there. It actually faced a lot of financial difficulties. Then, if it is not, if it is less than 0, adverse. If this figure here is greater than 0, comma, then we are talking about favorable. We are talking about favorable, right? And if it does not meet any of those conditions, then of course we just put an empty cell. An empty cell. An empty cell. Good. The other creditors raised out of good. So if this one here, the 10,000 pounds worth of debentures. If this one here is less than 0, we are going to have, right? We are going to have adverse. Then the second one, we now come here and say, if we bring in another if function, then if this one is greater than 0 now, we are going to have favorable, and if it does not meet any of those conditions, we talk about an empty cell, right? So BDS students are required to not just leave it or do it manually, but have a function right, to give us a comment on the status of the variances. Give us a comment on the status of the variances. So this is the additional thing for the BDA students. But of course, those who are doing AMA or those who are doing paper-based exams, you have just to put it manually because the paper-based exams does not provide for the use of those formulas. Yeah, that's the only thing you're going to add, and then you are good to go. And then you are good to go. Of course, you'll be able to learn that. This video will be available in our YouTube. Variances for sales brings a positive figure on my side. Yes, it is giving you a positive figure, but let me ask you a question. If you budgeted to get revenue of 1,360,000 and you actually got 1,326,000, which is less, will you be happy that you've gotten less amount? Will you be happy that you've gotten less amount? Yes, because that's why that negative is, that positive is not really a positive. No. That positive is not really a positive. It is a loss. So that's why we put the adverse sign there, right? Good. So I believe you have been able to understand what is going on. The remaining parts, any other explanation, we'll be able to do it in class. So if you've not joined our classes, please take a screenshot of this guidance here, join the classes so that we do more questions, more illustrations, right? Especially those who are taking management accounting, ensure you pay before 6 p.m. because today you have a class. And maybe our next topic would be this particular topic, that is budgetary control. So don't allow us to introduce this topic when you are not there. Let us introduce this topic together with you. So do your commitment and join our classes at exactly 6 p.m. today. Advanced Management Accounting students, you have a class on Sunday at 6 p.m. So ensure you do your payment before you miss the Sunday class, because you're also going to get to topic number 7, budgetary control, where this concept will be covered. Great. So the reconciliation statement, you are trying to reconcile. Why is it that this budgeted is not equal to actual? And which budget are we talking about? We have to compare it to the flexed, not just original. No, we take the flexed budget, whose net profit is 183,500 and the variances is 219,750, giving us actual net profit of 403,250, which actually we add here, right? Which actually we are given. So that marks the end of my presentation. You'll be able to access this video in our YouTube channel, that is Joshua Aura, so that you also listen to it at your own pace. For any inquiry, for any information, for any guidance, please reach out to these two people, then you will be guided. Thanks for your time and have a blessed afternoon.